Bismillahirrahmanirrahim. In this video, we are going to solve mathematical exercises on acquisition of minerals interest in property. We will solve exercises on working interest and net revenue interest before the lease and after the lease, undivided working interest, dividend interest, overriding interest, carved out production payment, and finally net profit interest. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the oil and gas companies and want to refresh their learning on acquisition of minerals interest in property. So let us solve an exercise on working interest and net revenue interest. Abdullah is the owner of a piece of land that is expected to have oil. Golden Oil Company, Futura, Green and Universal Company jointly lease the land to explore oil. They generally invest in the ratio of 5:3:2:1, and we have to calculate working interest and net revenue interest payable to Abdullah and the oil companies prior to the lease agreement. So prior to the lease agreement, Abdullah the lessor owns 100% of the working interest, and he also owns 100% of the net revenue interest, as there is no lease agreement. This is also called grand bargain. The oil companies prior to the lease agreement have 0% of working interest and 0% of net revenue interest. Okay, so this is part A, and when we go to part B, working interest and net revenue interest payable to Abdullah and the oil companies if Abdullah agrees for 1/8 of royalty interest. So after the lease agreement, Abdullah owns 0% of working interest and 1/8, or we can say 12.5% of net revenue interest. As now there is a lease agreement, the oil company have 100% of working interest and 7/8, or we can say 87.5% of net revenue interest. Let us solve another exercise. Now Abdullah, Ali, Fatima and Ragad own a piece of land in the ratio of 4:3:2:1. They enter into a lease agreement with Golden, Futura, Green and Universal Company. The companies jointly lease the land and have undivided working interest to explore oil. They generally invest in the ratio of this. The lessors and lessees have agreed for a 3/16 of royalty interest, and we are required to calculate working interest and royalty interest. So obviously the working interest and royalty interest will be after the lease, and after the lease the lessors Abdullah, Ali, Fatima and Ragad will have 0% of working interest. The lessors will receive 3 upon 16th of the production revenue as royalty interest, and the lessors will share the royalty in the ratio of 4 is to 3 is to 2 is to 1. After the lease, the lessees, that is the Golden, Futura, Green, and Universal companies, will have 100% working interest. They are the lessees and are not eligible for royalty interest as they are the lessees and not lessors. The lessees will share 1 minus 3 upon 16th of the 3 upon 16, that is 13 upon 16th of the revenue after they pay the royalty to the lessors. The lessors will not pay any cost. All cost of exploration will be borne by the lessees and they will share exploration cost in the ratio of 5 is to 3 is to 2 is to 1. Let us solve another exercise. Abdullah, Ali, Fatima and Raqad own a piece of land. They enter into a joint lease agreement with Golden, Futura, Green and Universal Company to explore oil. They generally invest in the ratio of 5:3 to 1 and have undivided working interest. The lessors and lessees have agreed for a 3 upon 16th of the royalty interest. We have to calculate working interest and royalty interest before the lease. So before the lease, the lessors they own 100% working interest and also 100% of the net revenue interest as there is no lease agreement, and don't forget this is called grand bargain. The lessees have 0% working interest and 0% net revenue interest before the lease. Now after the lease, the lessors own now 0% of working interest and 3 upon 16th, that is 3 upon 16, and this will be equal to 18.75% of royalty interest, as now there is a lease agreement with the oil companies. The oil companies will have 100% of the working interest and they will have 13 upon 16th or 81.25% of the revenue. Let us solve another exercise now. Abdullah, Ali, Fatima and Raqad own a piece of land. They enter into a joint lease agreement with Golden, Futura, Green and Universal to explore oil. They generally invest in this ratio and have undivided working interest. The lessors and lessees have agreed for a 3 upon 16th of royalty interest, and we have to calculate the working interest and royalty interest for each lessor. So after the lease, the lessors Abdullah, Ali, Fatima and Ragad will have 0%. They will have 0% working interest and the lessors will share 3 upon 16th of the production revenue as royalty interest. After the lease, the lessees, that is the Golden, Futura, Green and Universal Company, will have 100% working interest. They will have 100% working interest and the lessees are not eligible for royalty interest. Okay. Let us go to look into part B. And in part B, if the exploration cost is $15 million, calculate the cost to be paid by each lessor and lessee. We have to calculate the cost. So after the lease, the lessors Abdullah, Ali, Fatima and Ragad will not pay any exploration cost. They will receive only the royalty. And after the lease, the lessees, that is the Golden Oil Company, the Futura Oil Company, the Green Oil Company, Universal Oil Company, they are going to, since they are investing in the ratio of 5:3:2:1, so that is equal to 11, and they have to pay the entire cost of 15 million, and this will 2 3 4 5 6, and this will be 5 upon 11 times 15 million. This will be equal to 6,818, 6,818,182. This is going to be the cost to be paid by Golden Oil Company. For Futura, it will be 3 upon 11 of 15 million, and this will be equal to 4,090,909. For Green, this will be 2 upon 11 into 15, and this will be equal to 2,727,273. And for Universal Company, it will be 1 upon 11 times 15 million, and this will be 1,363,636. So if we make a total, this must be equal to 15 million, and if it is not equal, then there is a calculation mistake. Okay, now we move on to part C. If the existing lessees agree to lease 40% of the leased land to Green Oil Company for a 1/4 royalty interest, we have to calculate the working interest and royalty interest for each lessor and each lessee, assuming that the lessees have undivided interest. So if the existing lessees agree to lease 40% of the lease, so still the lessors, that is Abdullah, Ali, Fatima and Ragad, will not pay any exploration cost. They will only receive 3 upon 16 of royalty interest. Now, since 40% of the exploration, they have agreed to lease 40% of the leased land to Green Oil Company. So 40% of the exploration, development and production cost, 40% of 15 million. So this will be equal to 6 million, and this is the cost that will be paid by the Green Oil Company, while 60%, the balance amount of this 15 million, that will be equal to 9 million. This will be shared by the 4 companies, that is Golden Oil Company, Futura, Green and Universal, in their profit sharing ratio, that is 5:3:2:1. So they are going to share it in this ratio, and let us see this will be equal to how much. So now we have Golden Company, and they are same 5 upon 11. For Futura, it will be 3 upon 11. For Green, it will be 2 upon 11, and for Universal, it will be 1 upon 11, and this will be multiplied now by 9 million and not 15 million. So this will be equal to 4,90,909. For Futura, it will be 2,454,545. For Green Oil Company, this will be equal to 1,636,364, and for Universal it will be 818,182. So the total will be 9 million as already said. Also note that the Golden Oil Company, Futura, Green and Universal, they will share this cost in the ratio of 5:3:2:1 as already explained. And regarding the revenue, the Green Oil Company will receive 40% of the revenue after deducting the royalty of 3/16 for the lessors, and the remaining will be shared by the four companies, that is Golden, Futura, Green and Universal. So Golden, Futura, Green and Universal, they will be sharing 60%, 40% by Green and 60% by the other four, and they will be sharing 60% of this revenue, and this will be after deducting the 3/16 of the gross revenue as royalty interest. Okay, let me clean up this part for a minute. Okay, now we come to part D. If the existing lessees sell 100% of working interest in 40% of leased land to Bright Company. So now the Bright Company has 100% of working interest in 40% of the original leased land, and the Bright Company is responsible for paying 100% of the cost of exploring, developing and producing their 40% of land, and would be entitled to 100% of 13/16 of the gross revenue that will be generated on the 40% of the leased land. While Golden, Futura, Green and Universal Company, they will be responsible for paying 100% of the cost of exploring, developing and producing the remaining 60% of the leased land, and would be entitled for 100% of 3/16 of the gross revenue generated from their 60% of their remaining leased land. You can see now that Bright will be having 40%, so the remaining 60 is going to be for these four companies. So while the lessors, Abdullah, Ali, Fatima and Ragad, they will be receiving 3/16 of gross revenue from each respective property as royalty. Okay. So now let us solve another exercise. Abdullah, Ali, Fatma and Ragad own a piece of land and they are sharing in this ratio. They enter into a lease agreement again. They generally invest in the ratio of this. They agree for 3/16 of the royalty interest. So we have to calculate working interest and royalty interest after the lease for each lessor and lessee. So after the lease, the lessors Abdullah, Ali, Fatima and Ragad, they will be having 0% of working interest. and they will be only sharing 3 upon 16th of the production revenue as royalty interest. After the lease, the four companies, oil companies, Golden, Futura, Green, and Universal, they will be having 100% of working interest, and they are lessees, and that's why they are not eligible for any royalty interest. Now, if the exploration cost is $15 million, calculate the cost to be paid by each lessor and lessee. So after the lease, the lessees, that is the oil companies, they are going to pay 100% of the cost, and let us see how this will be allocated. So once again we have the companies, Golden Oil Company, we have Futura, we have Green, and we have Universal, and they are sharing in the ratio of 5, 3 to 1. So that is equal to, the total is 11. So once again we have the same 5 upon 11 times 15 million, that is 6818182. For Futura, it will be 3 upon 11 times 15, that is 4,090,909. For Green, it will be 2 upon 11 times 15 million, that is 2727273. And for Universal, it will be 1 upon 11 times 15, 1,363,636, that is equal to 15 million. Okay, we come to part C. Calculate working interest and royalty interest if the existing lessees agree to further lease the land to Greenland Oil Company for a 1/4 royalty interest. So still the lessors, that is Abdullah, Ali, Fatima and Ragad, will not pay any exploration cost, and they will receive the royalties as already stated, that is 3 upon 16 of gross revenue. Now the oil companies, that is Golden, Futura, Green and Universal, will not pay any exploration cost, and the Green Oil Company is going to receive 51 upon 64 of the revenue after paying. You see, now first of all they will be paying the royalty interest to Abdullah, Ali, Fatima and Ragad. So this will be equal to 13 upon 16, and then from this 1/4 will be taken away by the four oil companies, because they are leasing the land to Greenland in exchange of 1/4 of royalty interest. So for the four oil companies, Golden, Futura, Green and Universal, the royalty will be 13 upon 64, and the balance, now that will be 51 upon 64. This will be what is left for the Green Oil Company. Okay. Let us now move on to another exercise, and Mr. Ahmad, the landowner, leases a piece of land to Universal Oil Company and agree for 1/8 share of gross revenue. Universal Oil Company subsequently leases its interest to Grandula Company and retains 1/7 of overriding interest. The gross revenues earned in the first year is 12,500,000. We have to calculate the gross revenue to be shared by Mr. Ahmed, Universal Oil Company and Grandula Company. So obviously Ahmed is going to receive the royalty interest, and that will be how much? That will be 1 upon 8. 1 upon 8 of 12,500,000. So this will be equal to 1,562,500. For Universal Oil Company, this is going to be, now you see they are having 1 upon 7, so that will be 1 upon 7 times 12,500,000, and we will be subtracting the royalty already paid, 1,562,500. So this is going to be equal to 1,562,500. Okay, we move on to the third one, to the Grandula company. For the Grandula company, we have the total value of 12,500,000 minus the amount paid to the to Ahmed, that is 1,562,500, and the amount we paid to Universal Oil Company, that is 1,562,500. So this will be equal to 9,375,000. Now, if the total cost to earn 12,500,000 was 5,500,000, calculate the cost to be shared by Ahmed, Universal Oil Company, and Grandula Company. Now, Ahmed is not going to share any cost, and that will be 0%, as they are the lessors. Now, Universal Oil Company will also not share anything as far as the cost is concerned, because they have transferred the lease to Grandula and they have retained 1/7 of overriding interest. We come to the third one, that is Grandula, and obviously they are the one, and they are going to bear all the cost of 5,500,000. Okay, we move on to the next one. Sarah, the mineral owner, leases her land to Black Gold Oil Company. Sarah retains 12.5% mineral royalty. Black Gold Oil Company now owns obviously 100 minus 12.5, that is 87.5 of the revenue, as 12.5 was retained by Sarah. As compensation for identifying the drilling locations, Black Gold Oil Company assigns 2% overriding royalty interest to geologist Abdul Rahman. Calculate the revenue that will be split from the sale. So let us see how we are going to record. So Sarah is obviously going to have 12.5, and there will be no change with the addition of Abdul Rahman. And Abdul Rahman will be having 2% as already stated, but the oil company now is going to have not 87, because 2% is going to be taken away by the Abdul Rahman, so that will be 85.5%. Okay, let us look into one more exercise. The landman is speculating that oil company will be interested in leasing minerals owned by Sarah. The landman contacts her first and leases Sarah's minerals. The lease provides for a 12.5% royalty. Oil company wants to drill on Sarah's mineral, but now has to negotiate a deal with landman, who agrees to assign the lease to oil company and reserve 5% overriding royalty interest. So the amount payable to Sarah, landman, and oil company on successful drilling will be as follows. For Sarah, it is not going to change, it will be the same 12.5%. For landman, as he has agreed for 5%, so that will be 5%, and for oil company it will be 87.5 minus 5, that is going to be 82.5%. Okay. Next, let us solve one more exercise. Mr. Khalid is the owner of a piece of land. He leases the land to Black Gold Oil Exploration Company, who agreed to give 1/8 royalty interest to Khalid. Black Gold Oil Exploration Company transfers the working interest to Universal Oil Company and reserves 7% as overriding royalty interest. Later on, Universal Oil Company carves out, that is, sells production payment interest to Dragon Oil Company and reserves 3,300,000 production payment interest payable within 3 years. Universal Oil Company will receive a minimum of 75,000 each year as production payment interest. The gross revenue generated by sale of oil in the 3 years is given to us for the 4 years. So we have to calculate the royalty interest payable to Mr. Khalid. So let us look into the part 1 and royalty payable to Mr. Khalid. Now we have year 1, 2, 3 and 4, and the gross revenue is given here as 22 million, 18 million, 25 million and 19 million. So each year Khalid is going to get 1/8 as royalty interest. So 1/8 of 22 million, and this is how we are going to calculate 19 into 1 upon 8. So this will be equal to 2,750,000. This will be equal to 2,250,000. And this will be equal to 3,125,000, and the last one for the 4th year will be 2,375,000. Okay. Then we go to part 2, working interest of Black Gold Oil Exploration Company. Now the working interest for Black Gold Oil Exploration Company for each year will be 0 because they have transferred the lease. Then overriding interest of Black Gold Oil Exploration Company. So again we have the years, and this is part 3. Year 1, 2, 3 and 4, and the amounts are 22 million. This is the gross revenue, 22 million, 18 million, 25 million and 19 million. So royalty, obviously it will be 22 million minus the royalty already paid, 2,750,000, and we will be having the overriding interest of 7%. So 7% of this amount, that is 22 million minus 2,750,000, let me make it better. So 22 million minus 2,750 million and 7% of this amount, this will be equal to 1,347,500. For the second, 18 million minus 2,250, and this is 7% again, so this will be 1,102,500. For year 3, it will be 25 million minus 3,125,000, and 7% of this amount will be 1531250. For the fourth year, it will be 19 million minus 2,375,000 times 7%, that will be 1,163,750. Next, we calculate the working number 4, that is working interest of Universal Oil Company. So once again we have the years 1, 2, 3 and 4, and the gross revenue is 22 million, 18 million, 22 million, 18 million, 25 million and 19 million. And from this we are going to subtract 2,750, that is paid as royalty, and 1,347,500 we have paid to the as overriding interest. So the working interest of the Universal Oil Company is going to be 17,902,500. For the second year, it will be 18 million minus 2,250,000 minus 1,102,500. So that will give us 14,647,500. For third year, it will be 25 million minus 3,125 paid to Mr. Khalid, and minus 1,531,250. So that will be equal to 20,343,750. For the fourth year, we have 19 million minus the royalty paid in the fourth year to Khalid, 2,375,000 minus 1,163,750 as the overriding royalty interest. So this will be equal to 15,461,250. Finally, the production payment interest payable to Universal Oil Company. Now, the production payment interest that is payable to Universal Oil Company is 75,000 each year for a period of 4 years. Okay. It is going to be for a period of 3 years, not 4 years. Production payment interest payable within 3 years. So the Universal Oil Company will receive a minimum of 75 each year. So 75 each year. So 75 for times 3, 3 5 is 15, that will be 22,500, and 225,000. But the Universal Oil Company carves out to Dragon Oil Company and reserves 300,000. So they have to be paid 300,000 within a period of 3 years. It will not be 75, I am sorry for that. They are going to be paid 300,000 within period of 3 years, and the minimum amount of payment each year will be 75,000. Okay. Let us go to the next exercise. Mr. Samir is the owner of a piece of land. He leases the land to Black Gold Oil Exploration Company, who agree to give 1/8 royalty interest to Samir. Black Gold Oil Exploration Company transfers the working interest to Universal Oil Company and reserves 20% as net profit interest. The gross revenue earned in the first year was 15 and the cost incurred was 975,000. We have to calculate royalty interest payable to Samir. So royalty interest, so now the on part 1. So the gross revenue is 15 million, and from this he will be getting 1/8. So this will be equal to 1,875,000 as royalty interest. Then we have to calculate the working interest of Black Gold Oil Exploration Company. So for the we have the gross revenue of 15 million, and from this we are going to subtract the royalty interest we have already paid, and the balance amount will be equal to how much? 125, 13,125,000. We go to part 3. Net profit interest payable to Black Gold Oil Corporation. So once again we have the total revenue of 15 million, and the cost is 975,000. So the net profit will be equal to 14,025,000. Okay, we move on to number 4. The net profit that is payable to Black Gold Oil Company is going to be how much? 20%, that is 1/5. Then it does, that will be equal to okay, so we have 14,000 and 14,025,000, 14,025,000, and from this 20% is a reserve, so 20% will be 2,805,000. We go to number 4, working interest of Universal Oil Company. So the working interest of Universal Oil Company is obviously 100%, and no one is going to share that part. And we go to number 5, the net profit interest payable to Black Gold Oil Corporation. So the net profit we have already calculated. Net profit is 14,025,000, and from this we are going to subtract the net profit in interest payable to Black Gold Oil Corporation, that is 2,805,000. So this will be equal to 11,220,000. Okay. So this completes our explanation on exploration of minerals interest. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. And one last thing before I go, if you have any suggestions for future topics or any feedback, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.